What's up, everyone? Brand the Mortgage Man here, and today I'm going to talk about a topic that will severely change the housing market in 2024. It's the current condo crash. So I've helped more than 10,000 home buyers over my 20-plus year career, putting me in the top 1% of loan originators nationwide. Many of my clients have purchased condos, but things have severely changed as of 2022, and it was all triggered by one major event. In this video, I'll discuss what that event was, how these changes will affect current condo owners as well as future condo buyers, and its impact on the condo lending environment. So let me read you an article from the Miami Herald this week. Ivan Rodriguez leapt at the chance to buy a unit at the Cricket Club, an exclusive bayfront condominium in North Miami. In 2019, he liquidated his 401k retirement account to purchase a nearly 1,500 square foot unit with water views for $190,000. But because of recent state law that requires older buildings to meet certain structural safety standards, the Condo Board recently proposed a nearly $30 million special assessment for repairs, including roof replacement and facade waterproofing. It would amount to more than $134,000 per unit owner. Rodriguez, 76, didn't have the money, so he reluctantly put his two-bedroom condo up for sale, joining dozens of others in the building who are doing the same. After originally listing his unit for $350,000, he kept marking it down until it finally sold for $110,000 last month, or 42% less than what he originally paid for it. He says, every time a potential buyer learned of the assessment, they would run the opposite direction. So this is a huge problem. But what prompted these changes that led to his building requiring an assessment for $134,000 per unit owner? Well, this all goes back to the Surfside collapse. So if you're not familiar with that, the Surfside condo collapse was a tragic incident that occurred in June of 2021 in Surfside, Florida, which is Miami, Florida. A 12-story condominium building called Champlain Towers partially collapsed, and it resulted in the loss of 98 lives. The collapse raised significant concerns about building safety, maintenance, and inspections, which prompted investigations into potential structural issues and contributing factors. The incident sparked discussions about the importance of regular inspections, maintenance protocols, and building code enforcement to prevent similar tragedies in the future. And this is where the 2022 Condo Safety Act came into play. So the 2022 Condo Safety Act are provisions that aim to enhance the safety and resilience of condominium buildings, protect their residents and occupants, and prevent tragedies like this building collapse or other safety hazards. Mandatory inspections are now required. These are regular structural inspections of the condominium buildings to identify potential safety hazards and structural deficiencies. There are also maintenance requirements now, implementing maintenance standards for condominiums to ensure the upkeep of building components and systems. These include structural elements, electrical, plumbing, and fire safety systems. Now they're also requiring reserve funds, mandating condominium associations to establish reserve funds for ongoing maintenance, repairs, and future capital expenditures related to building safety and structural integrity, and transparency and disclosure. It requires condominium associations to provide residents with information about building inspections, maintenance activities, and any identified safety concerns. They also have to follow building code compliance, ensuring that condominium buildings comply with relevant building codes and standards to promote structural safety and resilience. And enforcement and oversight needs to be in place, establishing mechanisms for enforcing compliance with safety regulations, as well as oversight by regulatory agencies to monitor condominium safety and address any violations. They need to have emergency preparedness, implementing protocols and procedures for emergency preparedness, evacuation plans, and response measures in the event of safety-related incidents. Now, here are some possible requirements for reserves and inspections. So, reserve requirements aim to ensure that condominium associations have sufficient financial resources to address ongoing maintenance needs and unexpected expenses, promoting the long-term safety and sustainability of the condo building. So, mandatory reserve studies are key. These require condominium associations to conduct regular reserve studies to assess the current condition of the building components and estimate future repair and replacement costs. They also have reserve fund contributions, mandating condominium owners to contribute to a reserve fund on a regular basis to ensure adequate funding for future maintenance, repairs, and capital expenditures. They need minimum reserve funding levels, establishing minimum funding levels for reserve funds based on the results of the reserve studies and the estimated cost of necessary repairs and replacements over time. The use of reserve funds, specifying permissible uses of reserve funds such as major repairs, replacements, or improvements related to the building's safety and structural integrity. Transparency and reporting, requiring condominium associations to provide regular reports to residents on the status of reserve funds, including contributions, expenditures, and projected funding needs. Now, let's talk about association fees, right? So condo reserves play a crucial role in determining condo association fees, stabilizing their finances, minimizing financial risk for owners, and ensuring the long-term sustainability of the condo community. So let's talk about determining fee levels. Condo reserves help cover future expenses for maintenance, repairs, and replacement of common elements within the condo complex. The amount needed for reserves is factored into the overall budget of the condo association. If reserves are insufficient, the association may need to increase fees to cover anticipated costs. Stabilizing fees. Having adequate reserves can help stabilize condo association fees over time. By planning for future expenses and setting aside funds and reserves, the association could avoid sudden fee hikes or special assessments to cover unexpected repairs or replacements, like what happened to that gentleman here in Miami. Mitigating special assessments. Special assessments are additional fees levied on condo owners to cover unexpected expenses when reserves are insufficient. By maintaining adequate reserves, the need for special assessments is reduced, minimizing financial burdens on condo owners. Once again, what happened to that gentleman in Miami. Attracting buyers and lenders. Prospective buyers and lenders often review the financial health of a condominium association before purchasing or financing a unit. Adequate reserves signal financial stability and responsible management, which can enhance property values and make units more attractive to buyers and lenders. Long-term maintenance planning. Condo reserves enable associations to plan for long-term maintenance needs and address aging infrastructure. By regularly contributing to reserves, associations can proactively address maintenance issues and extend the lifespan of common elements, ultimately reducing the need for costly repairs or replacements in the future. Here's an explanation of how the absence of reserves can lead to a special assessment. A lack of condo reserves can lead to special assessments when unexpected expenses arise that exceed the available funds in the association operating budget. Here's how that unfolds. Condominiums require ongoing maintenance, repairs, and occasional replacement of common elements such as roofs, elevators, parking lots, or even building exteriors. Additionally, unexpected emergencies like structural issues, plumbing leaks, or storm damage may occur. If there are inadequate reserves, it means the condominium association does not have the sufficient reserves set aside to cover those expenses, and it may need to rely on the operating budget to address them. However, the operating budget is typically allocated for regular expenses like utilities, landscaping, insurance, and admin costs. This is where special assessments come in. When faced with significant repair or replacement costs that exceed the available funds in the operating budget and reserves, the condominium association may levy a special assessment on unit owners to cover that shortfall. Special assessments are additional fees charged to unit owners on top of their regular association fees. And what's the financial burden on owners? Well, special assessments can impose a significant financial burden to those owners and require them to come up with a lump sum payment within a specified time frame. This unexpected expense can be challenging for most owners to afford, particularly if they were not prepared for it. What does this do to your values? Special assessments and the associated financial strain can negatively impact property values within the condo. Prospective buyers may be deterred by the prospect of future special assessments or may negotiate lower purchase prices to account for the financial risk. This is exactly what happened to that gentleman in Miami. He had to reduce the price of his condo so significantly because there were no buyers willing to pay, knowing that that large special assessment was right there. A lack of condo reserves leaves associations vulnerable to financial shortfalls when unexpected expenses arise, leading to special assessments that impose financial burdens on unit owners and can adversely affect property values. Maintaining adequate reserves is essential for the long-term financial health and stability of communities. I want to give you another story from the same community where Ivan Rodriguez, the gentleman in Miami, had the issues selling his unit. And then I'm going to get into why this affects those who are looking to finance units in these condominiums with these special assessments or lack of reserves, where that really becomes an issue. So, Maria Takuchin and her husband purchased their 7th floor bayfront unit at the Cricket Club in 2022 for $490,000. With a terrace and balcony, the apartment boasts 180-degree views of Miami and Biscayne Bay. They spent another $100,000 on renovations. They installed extra large format Italian porcelain tiles, redid the entire kitchen, adding marble countertop and an island. The first sign of the Cricket Club's financial shortfall came when banks wouldn't give them a mortgage unless they put down 25%, Takuchin said. The reason, the lender said, was that their building had no reserves. 2 years later, they face a six-figure assessment. So, let me explain why this was and why the 25, we'll get into why the lender told her they had to put 25% down back in 2022 when they bought the property, right? So state law previously allowed condos to waive reserve funding year after year, leading to many buildings, including this nearly 50-year-old building, keep next to nothing in savings. So now about 40 units in that building out of the 220 are listed for sale, but no one's interested in buying those, right? Because financing for those units has become near impossible, or let's pretty much impossible. They can only sell to a cash buyer. So condo financing, right, works like any other type of mortgage financing, but the primary difference is that the lender has to do an in-depth review of the condominium itself, not just you as the buyer. And one of the things that lenders are going to look at when they're doing that review is the condo's budget. And what they're going to look at in that budget is the reserves. Now, that woman who bought the unit in 2022 had to put down 25% according to her lender. The reason she had to do that is because she had to do what's called a limited condo review. Now, there's two types of condo reviews that lenders are going to do if you're buying a condo unit obtaining conventional financing. One is a full condo review. So if you're buying as a primary residence, meaning you're going to live in it, the lender's going to do a full condo review, meaning they're going to review the budget, the bylaws, so on and so forth. That budget needs to account for 10% specifically for reserves in order for a lender to lend in that building, just based on that alone, the budget alone. This building, in this example, didn't have 10% reserves. So the only way to get around a lender needing to review that budget and allowing someone to finance in that building at that point in time was to put 25% down. Putting 25% down on a primary residence condo allows for a limited condo review. A limited condo review does not look at the budget at all. So that's how they got around the non-reserves or lack of reserves in 2022 and why their lender told them they had to put 25% down. I don't know if they explained it in this much detail, but they did tell them, hey, they didn't have a good budget or a strong budget, therefore you have to put down 25%, right? This happens all the time. Why would you want to buy in a condo that's not budgeting enough money for reserves? It's putting you at risk. Here's something you need to keep in mind, right? And when I talk to realtors that are showing condos and they send us these properties to run numbers for their clients and they want to know, does this condo meet lending requirements, this and that. If it doesn't meet lending requirements, for us, it doesn't meet lending requirements for anyone, right? Doesn't mean go bring them to the next lender that's willing to lend in that building. Because what you want to keep in mind, if it's this difficult for your buyer to get financing in the building, think about how difficult it's going to be for them to sell it in the future. Yeah, they like it now. What if they don't like it 6 months from now or 12 months from now? Good luck selling that property. They're going to be in the same boat as these individuals who are having to take deep discounts, sell for a fraction of what they paid, right? Because of this. So just keep those things in mind. You know, approving the budget is great. A lot of these buildings are now following protocol here in Florida, right? They're required to put the reserves aside, especially going into 2025. It's a requirement. But condo financing has become increasingly difficult because a lot of these buildings weren't budgeting for these things. And now they do need new roofs and they don't have the reserves to put on the new roofs. And even if they do, if they're in the middle of making these improvements and they're health and safety related, you can't even get financing in those projects until the work is done. Think about that. Until that work is complete, which could be a year from now, you can't even obtain financing. So whether you want to refinance or you want to sell to someone else and someone wants to buy your unit, they can't finance it. You need a cash buyer to make that happen. So it's extremely, extremely important to keep in mind. Special assessments, because of deferred maintenance, affect someone that's putting down 25% or more. It doesn't make a difference, right? It used to be that you do the limited review or the full review, as I mentioned, but both of those, regardless of the type of review that's happening on the condominium, still require require this health and safety addendum to the condo questionnaire for all lenders. So if there's special assessments for deferred maintenance, you're gonna have an issue obtaining financing in the building. And if you're someone who owns the condo and you're trying to sell it, you're gonna have a hard time selling that to a finance buyer on that. And that's gonna drive down the prices that we talked about. We saw it, right? The Cricket Club. The gentleman was stuck selling his property for less than he paid for it in 2019. How is any property today worth less than it was 5 years ago? That's unheard of. But condos specifically are getting slammed because of these assessments. This is all gonna affect affordability, right? We know that that gentleman had to sell his unit because he didn't have the money to pay for the special assessment in full. But even if they weren't requiring him to pay the special assessment in full, the alternative would maybe break that up over a certain number of years, increasing the amount he has to pay monthly toward the association. A lot of people that are buying in condos, not everyone, but a lot, right, especially older, are on a fixed income. So if they're budgeted based on what the association fee was and what their expenditures are monthly based around that, and that triples or quadruples, it's no longer affordable, right? So not just about having to make a lump sum payment, the monthly payments may go to a point that's unaffordable, even if they own the property free and clear. If they're used to paying $1,000 a month and that goes to $2,500 a month and they're on a fixed income of $4,000 a month, well, now there's a big problem and they're forced to sell just like that gentleman was. This pushes down the desirability of the properties. The less desire there is for a property, the less resale value you're gonna have for that property, right? It's easier to sell a property to a larger pool of buyers, right? That's where single family homes are great because you can get any type of loan on a single family home, FHA, VA, conventional. When you go to condominiums, you're already limited on the type of financing you get. Add to that, if you can't even get financing and now you only have cash buyers, well, your pool of buyers just shrunk to near nothing, right? And when there's less people that can be in a position to buy your property, you're gonna get less money for that property. The more people that are vying for the same property are gonna pay more because they're competing with one another, right? So it's very, very important. Make sure that if you are in the market or you're a realtor watching this and you're helping people that are looking to buy condos, make sure you're working with a lender who can assist you and do these things up front. The last thing you want is to go under contract on a condominium and find out that you can't even qualify for the condominium because it doesn't have the reserves, as an example, or there are special assessments in place, or it's doing these health and safety upgrades to the property, right? Find those things out beforehand. You never want to pay for a condo questionnaire because that's going to be a cost to you. Pay for an appraisal, pay for inspections, and then find this out. Any good lender should be able to check these things for you in advance. Fannie Mae actually has a list of approved condos that have already met all requirements. So if you have a condo that you're interested in, you can provide the name of that condo to your lender. They should be able to check that for you and let you know whether or not that project is going to be eligible for financing. Just keep these things in mind if you're in the market for a condo, or as I said, if you're a realtor working with clients looking at condos. And what was once considered a more affordable housing option has quickly become less attractive due to these increased costs of ownership. And this has caused a rise in association fees and the assessments, right? By watching this video and expanding your knowledge prior to entering into a contract on a condo, it might save you thousands of dollars and heartache. If you found this information helpful, make sure to subscribe to my channel so you can continue educating yourself on real estate and mortgages, and make sure to leave a comment below if you have any questions about your own scenario. I reply to 100% of the comments left on my videos.